Did you know that every single time you buy your morning coffee, fill up your car with gas, or book a flight for a holiday, you are actively participating in the largest financial theater on planet Earth? What if I told you that this invisible force, which quietly shapes your daily life, holds the key to absolute financial freedom if you only knew how to read its script? Let me tell you a story about a marketplace that never sleeps. It's a world where trillions of dollars change hands in the blink of an eye, and it affects nearly every aspect of your existence without you even realizing it. We call this phenomenon Forex. In this journey, I am going to break down everything you need to know about navigating the fast-paced waters of foreign exchange. And don't worry about getting lost along the way. We've put together a completely free Forex trading beginner's guide that works hand in hand with this lesson. I'll show you exactly how to get your hands on it a little later. But first, let's understand what we are dealing with. So, what is Forex exactly? The word itself is just a mashup of foreign exchange, and it's commonly used to refer to a massive global network. Picture a colossal marketplace trading across every single corner of the globe. But instead of stalls selling clothes, tech, or food, this market deals exclusively in global currencies. It is an absolute beast, standing as the largest financial market in the world, with a staggering daily trading volume of over $6 trillion. Unlike the traditional stock market that shuts its doors at the end of the day, the Forex market breathes continuously. It stays open 24 hours a day, starting from 5 p.m. Sunday all the way to 5 p.m. Friday Eastern Time. You might wonder where the headquarters of this massive machine is located. The truth is, it's everywhere and nowhere all at once. Forex is a completely decentralized market. There is no single central authority, no giant building, and no master exchange that governs the whole thing. Instead, it is a living network of global banks, brokers, dealers, and even sovereign governments who trade currencies directly with one another day and night. By the way, if you find value in these insights, take a quick second to hit that like button. It truly helps our team keep crafting free educational content like this on YouTube. To find your footing in this world, you have to learn the language. Let's start with currency abbreviations. Every currency on Earth is represented by a unique three-letter code known as an ISO code. Let me introduce you to the main characters on our chart. First, you have USD, which is the United States dollar, often just called the greenback or the dollar. Then there's AUD, the Australian dollar, which traders affectionately call the Aussie. Right next to it is NZD, the New Zealand dollar, known in the pits as the Kiwi. EUR stands for the euro, the shared currency of Europe. CAD is the Canadian dollar, frequently referred to as the loonie or the CAD. GBP is the British pound, known simply as the pound or cable. JPY represents the Japanese yen, and finally CHF is the Swiss franc, known simply as the Swissy. In the world of Forex, currencies never walk alone. They are always traded in pairs. Why? Because the very act of trading Forex means you are buying one country's currency while simultaneously selling another's. Let's take the pound-dollar pair, GBP/USD, as our example. The very first currency listed in any pair is what we call the base currency, and the second one is the quote currency. Imagine you look at your screen and see a quote for GBP/USD sitting at 1.2655. What does that actually mean? It means that for every single British pound you put forward, you receive exactly 1.2655 US dollars in return. There is always an invisible number 1 standing right beside that base currency on the left. So, what happens when you actually pull the trigger on a trade? If you decide to buy a currency pair like the GBP/USD, or go long, as we say, you are placing a bet that the British pound is going to gain strength and appreciate, while the US dollar weakens or depreciates. On the flip side, if you decide to sell that pair, going short, you are anticipating that the pound will lose its value while the US dollar gains massive strength. This brings us to the titans of the market, the major currency pairs. These are the most heavily traded pairs in existence, and they all have one thing in common. They include the US dollar, representing the world's largest economy. When you are just starting out on your trading journey, I highly recommend sticking strictly to these majors. They possess the highest liquidity, meaning the market flows so smoothly that you can slip in and out of positions easily and fast. Plus, they offer much tighter bid-ask spreads, saving you money the moment you enter the room. To measure the microscopic movements in these exchange rates, we use a unit called a pip. A pip stands for percentage in point, or price interest point. It is the standardized measurement for the absolute smallest whole unit price move an exchange rate can make. Imagine the Australian dollar is currently valued at 0.6751. If it gains just 1 pip of value, that number ticks up to 0.6752. For most global currencies, the rate is written out to the 4th decimal place, meaning that 4th digit represents 1 whole pip. However, there are exceptions that break this rule, most notably the pairs crossed with the Japanese yen. The yen is typically quoted to just 2 decimal places. So, if a yen pair rises by 1 pip, it moves from 146.22 up to 146.23. Sometimes you'll even see a 5th decimal place on your screen. That is a pipette, which is a fractional pip representing 1/10 of a standard pip. Before we dive any deeper into the mechanics, I want to hear directly from you. Drop a comment below right now and tell us what specific trading topics we should break down next. And remember to hit that like button to keep these free videos coming. When we talk about the size of a trade in Forex, we don't talk in dollars or pounds, we talk in lot sizes. A standard lot represents a massive 100,000 units of the base currency. Because that's a lot of capital for an everyday retail trader, the market breaks it down further. A mini lot is 1/10 the size of a standard lot, capturing 10,000 units. Go smaller, and you find a micro lot, which represents 1,000 units. And for those who want to start with absolute precision, a nano lot represents just 100 units of the base currency. Every single transaction you make is bound by 2 distinct prices, the bid and the ask. These 2 values form the very bedrock of execution. When you want to buy an asset, you will always pay the ask price. When you want to sell that asset, you will always execute at the bid price. The thin air between these 2 numbers is what we call the spread. In essence, the bid-ask spread is the difference between what a dealer is willing to buy a currency for versus what they will sell it to you for. This spread covers the dealer's profit and the baseline cost of processing the transaction. It is quite simply the toll you pay to enter the market. Keep in mind that different brokers offer different spreads, and many offer variable spreads that widen or tighten drastically depending on what is happening in the market. As an individual retail trader sitting at home, you cannot simply plug directly into the global banking grid. You need a bridge, and that bridge is your broker. Brokers don't just give you access. They provide you with a superpower called leverage. Leverage is essentially using borrowed capital from the broker to command much larger positions than you could ever dream of holding with just the raw cash in your account. Think of leverage like a physical mechanical lever. With a long enough lever and just a tiny bit of muscle, you can lift an incredibly heavy boulder with minimal effort. Financial leverage works the exact same way. It turns up the volume on your trades, magnifying your purchasing power. But hear me clearly. With the potential for massive profits comes the exact same potential for devastating losses. It is a razor-sharp, double-edged sword. Leverage ratios vary wildly depending on your broker, running from 1 to 50, 1 to 100, or even up to 1 to 500. To hold these massive positions, you are required to deposit a small fraction of the trade's total value, which we call margin, to act as collateral. Now let's visualize the ocean that is market liquidity. Imagine a vast, bustling global square where thousands of massive institutions are trading back and forth. Because the market is so incredibly colossal, an ordinary transaction barely makes a ripple on the surface. It's like tossing a tiny pebble into the Atlantic Ocean. In a highly liquid market, there are so many active trades happening simultaneously that you can buy and sell instantly without causing a chaotic disruption to the exchange rate. But then, there are times when the ocean gets rough, and we enter the realm of market volatility. High volatility means prices are shifting rapidly and aggressively, charting a wild roller coaster ride of sudden, terrifying drops and steep vertical climbs. When you see these massive, wide swings on a chart, it means danger is high, but so is the potential reward. Conversely, low volatility is like a peaceful journey on a scenic railway. The price moves in small, gentle fluctuations, offering far less risk for your capital, but significantly less reward. What actually forces this sleeping giant to wake up and swing wildly? A massive storm of real-world factors. Things like runaway inflation, sudden shifts in market demand, or unexpected foreign policy announcements can ignite the charts. Political stability, economic data releases, and major interest rate decisions from central banks act as fuel for the fire. Even natural disasters or global crises can instantly reshape a currency's value. Because these factors are constantly interacting, speculating on these very fluctuations is exactly how independent traders make a living in the Forex market. So, how do successful traders actually make sense of all this chaos? They generally rely on two distinct schools of thought. The first is technical analysis. Think of a technical trader like a seasoned detective hunting down subtle clues left behind on the charts. They study historical price movements and ancient data, looking for recurring geometric patterns. The core philosophy here is simple. Human nature never changes, and because of that, history loves to repeat itself. By figuring out how the market reacted in the past under similar conditions, the detective tries to predict how it will behave tomorrow. Let me give you a few classic examples of this detective work in action. You look back at a chart and realize the price has been steadily painting a series of higher highs and higher lows. This is a clear moving uptrend. Believing that the momentum will hold, you look exclusively for long trades to ride that ascending wave. Or perhaps you notice the exact opposite. The price is carving out lower highs and lower lows, signaling a heavy downtrend. You look for short setups to trade with the downward slide. Sometimes you'll notice that every single time the price rallies up to a specific horizontal zone, it hits an invisible ceiling and reverses drastically. That tells you the area is a zone of intense interest for institutional sellers. You know that if the price ever climbs back to that ceiling in the future, there's a very high probability it will reject it again, creating a beautiful trading opportunity. Other times, you might map a clean diagonal trend line across the chart and notice the price bounces off it like a trampoline every time it touches. You bookmark that line, waiting for the price to return so you can catch the next bounce. The second master method is fundamental analysis. If technical analysis is detective work, fundamental analysis is like building a comprehensive weather forecast. As a meteorologist, you don't just look at a map. You analyze atmospheric pressure, wind speeds, and moisture levels to predict a storm. In Forex, a fundamental trader looks at a country's macroeconomic health and geopolitical stability to forecast the value of its currency. They dive into core economic indicators like GDP growth, inflation rates, and unemployment numbers to see if an economy is thriving or dying. They dissect central bank statements, government policy changes, and breaking news events, tracking how changes in interest rates alter monetary value. To keep their sanity amidst this endless stream of global data, traders use an economic calendar to track exactly when these major announcements are going to drop. As I promised you at the beginning of our story, you can fast-track your training by accessing our comprehensive Forex Trading Beginner's Guide. It is designed to work seamlessly alongside everything we covered today. Just slide down to the description below and click the link for instant, completely free access. Before you go, make sure to slam that like button to support our team so we can keep building these free resources for you, and definitely leave a comment letting us know what trading topic we should explore next. Until next time, trade safe.